California, for 5 minutes.
Thank you, Mr. Wield. I want to thank you for your testimony, and you gave some pretty staggering statistics there that I think should give us all pause. But in terms of capital formation for small growth companies, you recommend passing this Reg A change. What else should we be focused on here?
Well, I think there are three things that the House Financial Services Committee can think about. One is the Reg A passage, which is a big step forward in terms of knocking down the cost of capital and the certainty of raising money. The second is that the stock market itself, the way it's currently constructed, has deprived issuers of any real choice in market structure, and it's really optimized for the 10% of the largest market value stocks that represent 90% of the volume. It's a one-size-fits-all stock market. And I think that to create a market structure that, just like bridges, roads, and tunnels are infrastructure to the U.S. economy, so isn't the stock market. And if we don't have a way of paying for the research, sales support, and the liquidity provision that's so desperately needed by small-cap companies, then the low end of the market, the smaller companies, die on the vine. They wither on the vine, just like our communities would if we didn't have bridges, roads, and tunnels. The third thing is you might consider in the private markets, there are some archaic restrictions in the private markets, a prohibition against general solicitation and an inability for accredited investors effectively to be able to buy and sell stocks in the private markets. Those are things that could help capital formation.
So those things come to mind. I'm wondering if there is additional provisions in Dodd-Frank that sort of compound this problem of capital formation. And one of the frequent things we see in the financial press is the conversation about capital flight, about the decision to move business to Europe rather than to try to soldier through here.
To your point,
because in Europe they don't have any intention of following our lead on some of these particular provisions that have been raised as a concern, right? They've got a different regulatory framework there. There's certainty to it. And I think that a lot of businesses look at that and say, all right, we'll opt for that as the alternative. I mean, it's a mouse click away, basically, these days, to get to do business under a regulation that seems far more certain. I mean, we're in the throes of waiting for 300 rules to be written. We haven't been able to reach agreement, for example, between the SEC and CFTC and get them on the same page. 50 differences we know of so far, 60 more rules to come down the pike in the, by September, and after that, 40 more that we're waiting for. And in this environment, the derivatives business and a lot of other business seems to be flirting with relocating. Some of it's already happening. Do you see that as a challenge here?
Well, I see getting the regulation, right-sized for the company size to be absolutely critical. I think that's one of the themes that I've heard a little bit here from this panel, that what works for a $200 billion market value company isn't necessarily appropriate for a $100 million equity market value company.
We've made no adjustment yet, really, on Sarbanes-Oxley to address this problem, have we, really?
Well, there are some exclusions from 404 for sub-$75 million equity float value companies, so there have been some adjustments.
Do you think that's helping?
Well, I think the bigger issue, if you look at the charts that we submitted, Congressman, what was interesting is our discovery that the sub-$50 million equity market value companies started to disappear from the IPO market before Sarbanes-Oxley ever came into effect in 2002. That the implosion started in 1997.
I agree. And I gave these, in my opening statement, I gave these figures. I agree that erosion began for that portion of the market, but what's happened since is that the acceleration has included the entire market. So it's now just the smaller firm. It is across the board. It is, well, IPOs were now 13% of the market. We were 50% of the market. This is quite an adjustment. So I think we can attach some of this to the way in which Sarbanes-Oxley, for example, has really been, we've had a failure to address it in ways that solve at least that problem. I grant you, Mr. Wield, some of your other points in terms of what we have to do for the niche of the market that you're most interested in. But on top of it, I'm just saying it's the market in its entirety that we risk losing to Europe and elsewhere.
Well, I would tell you that if you don't get the growth side of the economy back in high gear,
Yes.
that it actually drags down the performance of the entirety of the economy, including the large cap stocks.
Yeah.
I was, to your point about moving capital offshore, I gave a presentation at the New York Stock Exchange to a bunch of pension fund trustees not that long ago, and I sat through a number of the presentations prior to my own. And it was very interesting how many consultants to the pension fund industry were advocating to American pension funds to move their money offshore to higher growth economies, the BRIC countries, which are Brazil, Russia, India, and China. That is very disturbing.
Thanks for that information. Yield back.
The gentleman yields back.
Yes,
Unless he has another question.
well, I've used all my time. So.
Well, with the unanimous consent, you can ask another question.
Yeah, I'll then ask another question if you don't mind. The NRSRO issue, that's been around for some time, and I was going to ask Mr. Deutsch, we had a few entities issuing what ended up being flawed rulings, but they were treated as the gold standard with few alternatives. It was very, very frustrating. And in 2006, we tried to correct that in the Credit Rating Agency Reform Act, which I think made some strides to promote competition. That was the goal there, and establish a more transparent ratings process. But unfortunately, the financial markets have turned upside down since the passage of that act, and clearly part of it was the credit rating agencies. But Dodd-Frank, I think, took a different approach here and essentially opened the NRSROs up to a very active trial bar. And when I laid out my initial statement here, I pointed out we had 97% of the lawsuits, you know, worldwide or here in the U.S. Well, the day after the law was enacted, the NRSROs refused to allow their ratings to be used, bringing a temporary freeze to the credit markets before the SEC promised not to enforce the provision. Where is the happy medium with the NRSROs? And we need to encourage due diligence among counterparties in the market, but essentially removing the rating agencies from the picture altogether seems to be overkill. So I was going to ask you, Mr. Deutsch, about that.
I have, I guess, multiple responses. I think first, credit ratings serve an important part of the financial markets. I'm not sure either side of the aisle will disagree with that. Second point is that creating policy reform around rating agencies has been extraordinarily perplexing. It's very challenging to try to figure out, in a market with some natural economies of scale, how to improve that market and make appreciable change. But I think,
you know, on that thought, let me give you some time to contemplate the answer, give it back to us in writing. We've got 20 seconds left of the vote, and I think Garrett's a little faster than me. If we head out right now, we can make that vote. Scott, or Mr. Chairman, I yield back. Are you ready? I'll get that answer in writing, all right?
Great.
Thank you very much.
Then the gentleman yields back, then